Я очень извиняюсь, что у меня слайды в последний момент не получилось их скомпилировать, и поэтому мне пришлось использовать слайды моего соавтора, который в Сингапуре делал эту презентацию. Действительно, сейчас работаем над этим проектом, поэтому просто какие-то файлы не нашлись на моем компьютере. Да, можно начинать?
Да.
Let me switch into English because I'm still not that very comfortable with some Russian terminology. So I'll be presenting this work in Russian, and I'll be sort of stumbling at each sentence, trying to find the right Russian words. So I'll just talk about this in English. And maybe next year I promise that I will start talking in Russian, these professional topics. But this is the work joined with Doklad Anderson, Oleg Nikolenko, and Peter Kyle, and it's basically it's called Intraday trading invariance for equity index futures. So we're interested here in thinking about prices, about price dynamics. It's a very old question: what determines the price dynamics? I was thinking that if I talk about this paper, potentially it can be useful for some of you, because I think some of you will be working on somewhat similar topics. So this is one of the big questions in finance: what determines the price? What determines how price moves? We know from the old literature that prices don't follow random walks. So the dynamics is much more complicated. Usually, the returns have fat tails, and sometimes they are autocorrelated. So there are all types of issues there. And so there's a very big literature on this topic, on thinking about what actually determines prices, or what determines volatility, what determines price dynamics. There are several ways to think about what determines price changes. One would be, one strand of literature would say that there's some information that comes into the market, and this information changes prices. So, for example, there can be some announcements on which price, if it's a good announcement, then the price will just jump up without a lot of trading. So this is one sort of way of thinking about this, that information that arrives to the market sort of drives price changes. Another way to think about price dynamics would be, and what determines price dynamics is to say that it's trading that determines how prices change. So the way in that literature people think about this would be that there's some natural flow, information flow about different securities, different firms. People, traders, get this information, they process this information, and they trade on them. And their trades basically move prices. So price changes have to be somehow related to trading of market participants. And this is a very old literature saying that what drives prices. There can be how can we think about trading, what it is? So some people would say that this is the number, we should look at the number of transactions. And so if we look at this new business time that is related to the number of transactions, then maybe we'll get something that looks like a random walk. Other people would say that maybe the business time runs with volume. not transaction, the number of transactions, but volume. And the very famous paper on this is the paper Technologica by Clark. That's 1973. So this is really 40 years ago. Sort of long time ago. So he would say that we need to look at we need to transform the time. Instead of looking at the development time, we have to look at the business time that will be running with the volume. So we are sort of coming back to this old literature, and what we'll be doing in this paper will suggest our own way how business time works, which is related to our research on market manufacturing variance, and we'll sort of see whether our model price changes can explain what we see in volume, volatility, and number of trades. I can tell you that these variables, like volatility, volume, the number of trades, and trade size, change quite a lot over time. And it's not very convenient for me to look at. But the data that we use in this paper is data on from the most liquid market in the world. It's S&P, E-mini S&P 500 futures. This is the futures on S&P 500 index. So it's traded on CME, and it's the most liquid security in the world. In terms of volume, I believe there will be about $150 billion turnover every day. So it's in terms of size, it's basically the size of that market is for futures is the same as the size of the total American market for all equities altogether, because the volume of American U.S. equities will be also about $150 billion per day. So it's really huge. For us, I have been doing some research recently on Russian currency market, and if we look at the very liquid Russian market, it's US ruble currency pair. It will be about 10 billion in spot transactions, and about per day, and about 10 billion in swap transactions. So this is just to put in the context a bit how active this particular contract, E-mini futures contract, is. So we will be looking at the data from 2008 to 2012, and on these pictures there are dynamics of how volume, for example, changed. This is volume in contracts, and this is volume per minute, for each minute. One contract is about $50,000, and so the average number of contracts executed per minute is about 2,000 of them. So you can imagine how large the numbers are. But so this is how volume has been changing. This is how volatility has been changing. Oops. The number of trades here and the trade size, the average trade size for each minute.
Could you please give a bit of detail? So I do not understand what is. So this information during the whole year.
Yeah. So this is.
And so we have some smaller grid.
This is for each day during this 3 years. For 4 years, it's the average volume. It's the average minute volume. So each day we calculate, for example, how many contracts have been transacted every
So
minute, and then we average.
in one unit there are grid 365 points.
Here,
Yes.
yes, so there will be, these are daily observations,
Okay.
but these are
Smooth somehow.
for each day. No, these are, I don't think that there's any.
So okay, so this means that the plot is for each day.
For each day, these are minute observations averaged. So each, it will be, for each day, it will be the average volume per minute, or the average volatility, or the average number of trades per minute, or the average trade size per minute. Yeah, in that sense, it's smoothly within the day, but not across days. So yeah, it's averaging within each day, but not across days, in that sense. So here you can recognize, for example, that in the beginning, looking at volatility, for example, that volatility changed here quite a lot. It spiked in the beginning of 2008. This will be the first spike is due to some trades of Jerome Kervier at Société Générale. There was some fraudulent positions accumulated by one rogue trader at Société Générale, and those positions had to be liquidated in the beginning of 2008, and they sort of created a lot of volatility in the markets. So that's sort of this spike. Then the second spike will be all this uncertainty related to Bear Stearns collapse in the US, and then this spike. This is like September 2008. This is the full-blown scale crisis in the US. Yeah, it started officially probably with Bear Stearns in late February, beginning of March, and then the markets were somewhat calm for a few months. I don't know exactly why. And then
May I
this
ask you, what is volatility?
volatility, it's again, it's a high frequency measure of volatility for each minute, average across days, average within day.
So historical volatility calculated
Yes.
assuming geometric Brownian motion as a model for prices.
And it's just realized volatility. So it's for each minute, this is sort of high frequency data. So for each minute we calculated the realized volatility for that particular minute, and then we average across all minutes within a day. This is one point.
Because I asked the question because sometimes there is some vague notion of volatility which is not clear. So,
Yeah,
okay, volatility, so this means that volatility in common sense. Okay.
There are hundreds of different ways to calculate volatility. This is realized volatility. And so it spiked a lot during the financial crisis, and it calmed down a bit. In May 2006, that's another spike here. This is due to May 6, 2010, when there was a sort of famous flash crash in exactly this market for E-mini futures that also inflated volatility.
Flash crash was only for 1 day. No?
Yeah, it was only it was only for half an hour.
Yes.
But the changes there were quite huge, and that would be related to this spike and all the sort of uncertainty that followed afterwards. And then somehow volatility spiked again at the end of 2011. I'm not exactly sure. I guess it's something related to Europe also. But anyway, my point here, you can look at all other charts here. You can see that this minute volume and number of trades and trade size, for example, changes really a lot. So it's not that these measures are stable somehow, but they change quite a lot. And we want to come up with a theory that will tie them all together for some nice formulas, so that these fluctuations will not look completely random. So the theory that we want to use the theories that exist, for example, here, one of them is an NG1 paper, sort of somewhat famous paper, saying that the paper was saying that if you look at the volatility, how volatility changes, this high frequency volatility, it can be explained by the number of trades, by the number of transactions. So if you look at the returns price process in this transaction plan, then volatility will be sort of constant. So they would say that the daily volatility should be related to the number of transactions, because if the number of transactions is large, it means that there was a lot of information that came to the market, and so volatility should increase, the variance should increase proportionately to the number of transactions.
Well, you mean that one can use random time change related with the volatility of the process?
Mm-hmm.
So it is a name. There are several papers, in fact, of Mark and Elliot and some others claiming that if you stretch the time according to volatility, this is actually the natural clock. This paper about this, because I do not know.
Well, this one is more about what will sort of. It's the same question, but it is asked slightly differently. It's more about what explains volatility of daily returns. The idea was that it's number of transactions, because the number of transactions is related to information flow. So when the number of transactions is large, volatility is large. So for them, the business time clock is related to the number of transactions.
Можно еще спросить, реализация валютилити за 1 минуту на каких интервалах считается? Как разговаривать?
Transaction by transaction.
Ну, можно равномерно интервалы считать.
No, so we look at each minute, and within each minute there are a lot of transactions, because it's a very active security. And so we just look at the realized volatility, basically going from one transaction price to another, and looking at the squares.
Но обычно преобразовать на одинаковые интервалы и вот сумму превращения. Но здесь не одинаковый интервал, если transaction.
Within each minute there can be different, but it's just realized volatility. So you just sum up all of the squared price changes, and then you get the
For each transaction.
Yeah. So if for 1 minute there were many different transactions that uneven.
Я думал, что нужно брать одинаковый интервал, превращение на одинаковых интервалов.
No, it realizes from transaction to transaction.
Когда считают реализацию на суточном интервале, берут на 5-минутных интервалах доходности и берут сумму квадратную.
You can calculate
Это
from
так
transaction.
стандартно некоторые. Я заинтересовался, что в пределах 1 минуты делается.
Even for each day you can calculate from transaction to transaction. Because that's.
Но это не получается равный интервал по времени.
But that's okay, because you just look at the variation of this process along the path, and presumably it has to converge to the measure of
Converge to something.
Yeah, but anyway, this paper of Anna Obижаевой, if I remember correctly, basically they would look at the distribution of returns, but in this business time related to the number of transactions, and then they will say that the distribution is somewhat similar across different times. It's interesting that this paper, even though it's quite famous, nobody can confirm these results, including my co-author here, Torben Andersen. So he spent a lot of time trying to replicate these results, and he basically says that he cannot do it, and he doesn't know anybody else who can replicate this paper. But
Sorry, and what is the result, in fact?
The result is they would look at the returns from transaction to transaction, and according to this hypothesis, if you look at this returns from transaction to transaction, not from the beginning of the day to the end of the day, but from transaction to transaction, then you should have something stable across different times, or across securities. I think they look at across times, across days, across times of the day or days. And they basically report that they get something stable, and other people cannot replicate this. But we want to think about this differently. We want to think about this from the perspective of market structure invariance, which is this theory that I have presented when I came here maybe 6 months ago.
Yeah.
I don't know how many of you have been here, but I have been sort of talking about this.
October or November.
I think so. So I have been talking quite a lot about this theory on market structure invariance, which is basically which is based on the idea that that all of the financial markets are the same, but they run at a different time speed. So if you have active markets and the business time clock is very fast, and if you look at the slow illiquid securities and the business time, they runs very slowly. At the same time, if you sort of compress slowly moving markets into one day, then you may get something that will be very similar to the actively traded securities. I will tell you how exactly we want to extend this other research that I had to get some insights about this particular questions. But what we want to explain is, for example, intraday market activity patterns. This is a nice picture that shows how different variables are changing across days. So again, if we look carefully at what happens within each day, there are all types of different patterns that are very interesting. Maybe you know about some of them. So this is, for example, this is volume. So this is from -6 to 15. This is basically 24, the security E-mini futures is traded 24 hours a day almost. It is traded even overnight, because it has been traded on this electronic Globex platform, and except for half an hour breaks only somewhere after 4 p.m. Basically it has been traded 24 hours a day. So these are almost all of the 24 hours here. We divide the whole day into 3 regions with this vertical lines. So the first one is related to Asian markets. I think it's still, I think it's in US time, it will be from like about 5 p.m. to 2 a.m. at night. So this is basically when US market is closed and Asian market is open. Then the next region between these 2 vertical lines, these are European trading hours. So this is when all of the trading activities are is shifted to European markets. And this is this vertical line. It's at 8:30. It's 8:30 Central Time in the US. It's Chicago time. That's where CME is. So this is when 8:30 is the time when American equities markets are open. So this is the third regime when American markets are open. You can see here again that there are quite different patterns there.
So this means that still this Standard & Poor's 500 the information. So it is this plot reflects only very special traits of basically American securities. So in Asia, of course, there are local securities traded in much larger volumes. Okay, so this is special.
Yeah, this is only for E-mini futures, for that particular contract,
Yeah.
because it is traded 24 hours a day, even when the market is closed. It's Asian, I guess Asian traders, so I don't know who is there, but they're also trading this futures.
But in
because,
small, very small volumes. So
Doesn't
Still
depend
quite-
on volumes. Maybe
No,
much
it
more
is-
new information
it
than
is volume,
US market is
volume,
open.
volume. The first plot is about volume.
yeah, it's quite small
So-
relative to American markets. It's still, I guess it's sufficiently large. It's just that when American markets are open, we have this, we certainly have much more volume than an Asian market. But this is really like the most liquid market in the world, for the most liquid content in the world. But it's true that during the Asian hours there is not a lot of trading, and in the US trading hours, North America trading hours, there is quite a lot of trading. And you can see here also how volatility is changing. Volatility also goes up. The number of trades is also the same. The trade size also goes up quite a lot during the North American trading hours. So on this picture, here each point corresponds to 1 minute in this particular, for this 24 hours. And for each minute, for example, this one, it's 10 a.m. Yeah, so this one. So we look at all of the days, all of the, during those 3-4 years that we have, and we calculate at 10 a.m. for 1 minute how much volume has been traded at that particular minute, and then we average across all days. So this would correspond to some sort of intraday patterns in those variables. The famous patterns are that usually there are these U-shaped patterns, because this is like U. So you can see that volume is quite high at the beginning of US markets, and it's quite high at the end of US markets. So usually it's always this U-shape. It's quite small during lunchtime. Probably
Is
because,
this average data over 4 years?
yes,
For each day?
yeah. But still for most of the days there'll be also this U-shaped pattern.
Still, for average data, it's surprising to have these spikes.
Yeah, these spikes are quite interesting because actually this finishing talking about this U-shaped patterns. If we look at the log of this variable, you will see also that there are some U-shaped patterns also within Asian hours and within European hours. It's quite interesting why we have this U-shaped patterns. These spikes occur at some particular minutes. Yeah, because we actually want to keep those spikes because we want to explain them also. So we don't want to average over longer periods of time. We want to sort of decide to look at 1 minute.
So what is special for this particular spike?
So this spike, for example, this one corresponds to 7:30. That's Chicago time. So this will be 8:30 the East Coast time, and this is when a lot of announcements are made. And during that particular minute, at sort of 7:30, prices change a lot, and there's also some volume, and you can see that that volume spikes here, volatility spikes here a lot.
Yeah, it's
And
very
so the
large
number of
spikes,
trades
but
also
there is
spikes.
a lot of small spikes, also regular.
Yeah,
So
this
it's
would be.
a lot of fixed minutes.
I would say this is something related to the beginning of the hour. Yeah. So there's certainly
Beginning
some.
of each hour?
I I think so, yeah.
What is special with the
Well, somehow some people trade at those particular minutes. Because
Среднем по 4 года. 800 наблюдений.
Все равно какая-то погрешность.
Да нет, получается, сказать, сезонность такая по минутам.
yeah, so I talked at some point, some people in banks who do optimal execution strategies, for example. So some of them surprised me, saying that, as we talked about this other paper that you mentioned, optimal execution strategy, on how to execute order over, like if you have some fixed period of time, one day, and you want to buy or sell some large order, how you want to execute it. So a lot of banks apparently they sort of do some optimization on how much to execute every hour, for example. And then they just execute at the beginning of the hour, exactly at 10 a.m., 11 a.m., 12. Sort of instead of, for me, it doesn't. I mean, it looks sort of not optimal, and because it would be much better if you want to execute your order, you want to heighten the order flow. You don't want to execute your order at those given hours. You want to randomize it a bit and smooth it out. But it seems to me that there's a common practice to that at least some of market participants execute their orders exactly at 11 a.m., for example, and we can see it in the data. The other patterns would be that some of the crossing networks do crosses also at even hours, not the round hours, and so this will be also reflected in those spikes. But this is what the data tells us. Huge spike is at the very end of the trading day. So this is exactly when this is like 15 here. So it's 4 p.m. East Coast time, and so this is exactly when U.S. equities market is closing. So there are also a lot of activities happening at 4 p.m. U.S. close price, because that price is very, very important for various calculations. When we, for example, calculate net asset value of a mutual fund, you usually take the 4 p.m. closing price. Anyway, we want to explain all those patterns minute by minute. And you can see, for example, why the theory of a measurement will not work exactly. Because they will say that volatility should go up when the number of trades is large. That volatility should be related to how many trades were executed during that particular 1 minute period. And usually it's true. Usually when volatility is large, the number of trades is also large. So there are these patterns that both volatility and the number of trades have the same U-shaped pattern. But if you look at the very last minute, for example, here at 4 p.m., volatility doesn't go up. This is a 4 p.m. volatility estimate. But at the same time, the number of trades actually spikes up. So according to the theory that volatility should be proportional to the number of trades, we should see also the spike in volatility at 4 p.m. here. But we don't see it. This is just one of the, this is just a glimpse of why those alternative theories will not work. But this is just a bit more details about the information that we have. So we'll have almost 959 trading days that we are looking at. Basically, these are all days. I think we exclude just a couple of days that were holidays. This is really like we exclude maybe 5 days. Because there's not a lot of trading activity there. There will be more than 1,300 1-minute intervals during the day. This is exactly, so we have 1,300 points on the previous chart here. So there will be 1300 points. And for each point, for each day, D is the day, T is the time of the day. We calculate all these different variables: number of transactions per minute, the average trade size, prices, volatility, and we also calculate this what we call W. This is our measure of trading activity. It's volume times volatility, dollar volume times volatility. I'll show you why it's important. And in terms of the data that we use, it's the front month contract. So because you know that futures expire once in a while, and so if you want to have continuous time series of prices and volume, you sort of want to switch from one contract to another when the contract gets expired. So we always look at the front month contract here until week before expiration. So this is a common practice of how people do it. In terms of the numbers, for three regimes here, what can we see? Well, volume. This is the 1 minute volume. It really changes a lot. It basically increased like 50 times. If we compare Asian regime, this number with the US regime, the number of trades also increases quite a lot, almost by a factor of 20, from the liquid sort of slow regime to big regime. Okay, in terms of what else is interesting here, another interesting thing is that market depth. So market depth is how many contracts are outstanding on the best bid and the best ask. So this is how much depth is available for traders to trade each time. You can see that the amount of depth here is just extraordinary, because during the American trading hours, it's almost 1,000 contracts available. So you need to multiply this by 50,000 approximately. So you can basically trade the order of about 50 million during those hours without changing the price much, just executing your orders at the bid or at the ask. So there's a huge amount of liquidity there, and the average size, trade size, is about 12 contracts. You can see that this is sort of the order. That's how much people usually trade. That's the size of the orders, and you can see that the orders are really much smaller than the amount of liquidity available at the bid and the ask. So this is a particular feature of this market. It's probably related to the fact that actually tick size is very large here. So the tick size is it's a quarter of the index point. So it's about it will be about $25 for each contract, for each like $50,000 contract. So my point is that you can see that if we calculate the bid-ask spread is very similar to the tick size. So it means that the tick size is very restrictive in this market. The tick size is very large. This market is so active that it basically requires a smaller tick size. But the tick size here is very large. When the tick size is very large, then what happens to the market depth? Well, you just have less price levels, fewer price levels in the linear book, and on each of the price level, you will have a lot of contracts accumulated on the bid and on the ask.
So tick size is related with the size of a contract also?
Yes.
So what is the size of a contract?
$50,000. So the tick size, the percentage tick size will be about 2.5 basis points, which is maybe it's not large for equities market, but this market is much more liquid, it runs much faster. So it sort of requires the tick size to be smaller. And so the tick size that exists in this market is very restricted for how people behave. In particular, for example, consider market depth is just extraordinary here in terms of how much you can trade without changing the price much. So, what about other restrictions? The minimum lot size is one contract. So people can trade one contract. Usually there are some restrictions on how much people can trade. In the US equities market, they can usually trade 100 shares. That's the minimum lot size. Here it's one contract, and you can see that this is a fraction of, again, it's sort of for this 24 hours intraday patterns. You can see that this is the number of trades equal with one contract, and this is the number of trades, the green one, with one or two contracts. But quite a huge number, so it's about 40–50% of all trades are executed as one contract. Of course, each contract is huge, it's $50,000. But this will be somewhat less restrictive actually than for typical stocks. I would say that the lot size of 100 shares is probably slightly more restricted than this one. You can see also on the right here, this will be the proportion of the trades larger than 50 and 200 contracts. So these are gigantic numbers. 200 contracts will be how much? So it will be 1 million. That's just one order that you execute without splitting it. Just execute in one shot 1 million. Because this is information about trades. So this is the size of trades, and there are really a lot of in liquid, yes, hours. There is like 6% of orders larger than 50 contracts. So this are really again probably only in this market you can execute orders of this size so easily. But I can say also that this market, this instrument is very popular among all of the institutional investors. A lot of pension plans, endowments, foundations will be trading, or sovereign wealth funds will be trading in this market, and they'll be trading huge quantities because they have huge amounts of assets under management in their portfolio.
In this market, mainly human trades, or
no, it's all electronic long time ago because it's most markets are electronic now. So this is Globex. This is probably some of the most advanced technology for sort of how to organize trading. I think they license it to all other markets. I think even our Moscow exchange probably is using that technology. Yeah, so that's this is South Korea. I know stock market will use the same platform. So yeah, these are all electronic exchanges. There are no retail investors there because people usually will not be trading $50,000 in one shot. Yeah, it's only institutions that will be executing these huge quantities if they want to hedge some positions or maybe change their strategic allocation. So finally talking about, I don't know, how much time do I have? When should I stop it? So
half an hour.
At least 20 minutes or
okay.
if you want.
So I'll try to show you some pictures finally. But the idea is that we take the invariance. So the invariance, this is the formula for that we'll get in invariance. So the invariance is this idea that all markets are invariant in some sense in terms of how much risk is being transferred by each of the bet. And bet is not exactly the same as a trade. Bet is more like a big decision to buy or sell, which will be more related to meta orders that institutions want to execute. Those meta orders will not be executed usually as one shot, but they'll be shredded over time into sequences of smaller transactions. So our invariance theory has been formulated for these original meta orders, but we will try to apply it for transactions that we see in the data. So the invariance would say that, without going much into details, that if we look at the order, its price times the size of the meta order, and then we multiply it by volatility in transaction time. Well, not in transaction time, but in this business time, where business time is counted by the number of bets, and B is the number of bets that arrive to the market. So this will be these two variables, that's volatility in business time. We count business time not with the number of transactions, not with the volume, but with the number of these bets that arrive to the market and new ideas that arrive to the market, and sort of counting each of the new tick in this business time. So this volatility multiplied by order size says that this is the amount of risk transferred by each bet. It will be also related to the number of the amount of money made on this bet. It will be related to the transaction costs for executing each bet. And we say that this is invariant. So we have like a lot of other papers and both sort of empirical and theoretical papers that will come in which we will get this this particular invariance.
I'm sorry, and bets, for bets, statistics you didn't show, so, but it does exist.
Well, for bets, here we don't talk about bets, but in the other papers that we have, we will look at some meta orders of institutional investors, and we'll say that this might be a good process for bets, and then we'll see whether our predictions are related to what we see in the data. And we saw that they are quite related. But anyway, so we take this, the other implications would be how the number of bets and B. So this is the number of bets executed each day. And their size, this is QB, it's their size, are related to trading activity, market activity. And market activity is sort of the average amount of risk transferred daily. It's dollar volume, price times volume, times daily volatility. So W is more like it's sort of risk-adjusted volume. So this is our measure of trading activity. And if you do just very simple calculations and use this previous formula, this one, then you can basically get this results that when trading activity increases, that's W, when markets are becoming more active, when the volume is larger, volatility is larger, then it should be that the number of bets is related to W in 2/3 power, and the size is related to W in 1/3 power. So meaning that if you increase, if you go from the market, from one market to another one that has 8 times more volume, then it should be that in these more active markets there will be 4 times more bets, and they will be twice larger. So some of the increase in the market activity comes from the increase in number of bets and 2/3 of it, and some part of it comes from those bets being larger. So this is 1/3 of it. So we take this, as I said, we tested those implications in some other data sets, but what we want to do in this one, in this paper, we want to sort of write the same invariance principles for intraday high frequency data. So we just sort of say that let's maybe assume that if we look at this object, if we look at the markets in transaction time, so now MDT, that's the number of transactions in day T at time T. So if we if we write the same invariant, so this is the side, that's price for that particular point, the average trade size also for that particular minute of that particular day, and then we sort of multiply by volatility also for that particular point, scaled by the square root of the number of trades. Then we should get something invariant. And we just sort of assume that, well, not assume, but we postulate this hypothesis that maybe it will work, not even in the intraday data. So there is not, frankly speaking, not a lot of theory behind it. It's a very big step from our original theory that formulated for bets into this one that is more related to transactions. But interestingly, yeah, and so we can sort of formulate similar results that, for example, the log of n, the log of the number of transactions should be linearly related to the log of w with the 2/3 power. So that's sort of the same as this one, yeah, but we just take the log on both sides. So we predict that this coefficient here should be 2/3. And so we can test it. So we can look at if we look at the intraday results, so we can calculate the average sort of log of number of trades for that particular minute, for example, 10 a.m. And then we can regress it on what was the average log of W for that particular, also for that particular minute of the day. And the question is whether we'll have 2/3 power here, or 2/3 coefficient here. So this is basically what we get. That's one of our favorite pictures. So here we have on the horizontal axis we have the log of W. The log of W is the product of dollar volume and volatility. And so it's a log of W on the horizontal axis, and it's a log of that's the number of transactions on the vertical axis for each particular minute. Remember, there was about 1,300 of those minutes. And you can see that basically they all line up along the same line, which is exactly the slope 2/3. So this is, and this is sort of two good results to be true. But this is, if we run just this particular regressions for our data, we will get exactly the coefficient of 2/3. These different colors would correspond to different regimes. So the blue one would be the Asian regime. This is the European one, and this is the American. Of course, the American one would have much higher. It's more liquid market, so it will its W will be much higher usually because there's a lot of trade activity. There's a lot of volume. These crosses are also quite interesting. These are crosses for the last 16 minutes of the day. So this is sort of exactly after 4 p.m. after the U.S. market for equities is closed. Then there's another 15 minutes when U.S. futures market is open. So these are 16-15 points when futures are traded, but the corresponding underlying market for U.S. equities is closed because it's closed at 4 p.m. Interestingly, all these crosses are basically again on the line with the slope 2/3, but it's slightly lower than the line itself is slightly lower than our point that will match all other the line that will match all other points. So one of the explanations here for us would be that we probably need to think much more carefully about how we deal with these economically related markets, because we certainly use, when we calculate W, we calculate trading activity only for futures market, only for this E-mini futures contracts. But certainly there is a big market of U.S. equities that is economically related to these futures. And it's a bit sort of unclear how exactly we should adjust our invariance theories to take into account existence of these different markets, because potentially you can get liquidity not only in mini futures market, but also just buying 500 of equities in normal US market. So, and then this is our main result, I would say. Then we have a lot of other sort of similar results, because we can, we can rewrite our implications and predictions in all other possible ways. For example, quite often, as I discussed before, people are interested in volatility. Volatility is very important for option pricing. It's one of the important variables in option pricing, in derivatives, and so people are very much interested in calculating volatility. And as I said, there are different theories that would try to explain volatility. So Clark would say, for example, that volatility is related, variance is related to volume. And this other, the whole other set of papers would say that variance should be proportional to the number of transactions. So all of this, and of course we can sort of write our own prediction about what volatility variance should be, and that will be, also it will have will have some sort of particular prediction about it. But we can sort of okay, so yeah, so this would be, actually it's still n. So this will be our prediction for n. We will say it's 2/3, but all other theories can be also written in terms of their predictions about the number of transactions and how they are related to maybe W. Our theory will say it's only related to W. But these other alternative theories would say that you also have to adjust for Q. And the predictions will be that beta in all those regressions should be 2/3. I sort of skip a bit how we derive this equation, because it's really just one line of math. It's just taking into account that W is the product of price, volume, and volatility, and volume itself is the product of average size and the number of the average trade size and the number of trades. So basically, we don't use any other equations here. And so we run these regressions again for Clark, Anne Obижаевой, and our invariance. So all of us would predict that the model should give us 2/3. And it's basically only our model that will give the result of 2/3. In terms of pictures, this is our picture. And these are alternative pictures. So all of them would say that all of the observations should be on one line, and that line should be exactly 2/3. You can see that only for our picture, the line is actually exactly 2/3. For all other alternative theories, they're just they don't fit. They don't fit the data at all. Well, maybe not at all, but much worse than our theory. So another sort of set of interesting pictures would be, we can sort of write it in terms of variance, as I said, daily volatility of variance of daily returns. Clark would say it's proportional to volume. Anne Obижаевой would say it's proportional to n, and we will say that it's proportional to n divided by q squared. This is just what we get from the formulas. And we can sort of test all this and see, we can actually calculate, because we know how to calculate variance, and then we can see whether it's, what sort of results we actually have in the data. And so I think that, actually this is some old results here, but we can sort of write this also in terms of logs. When you write it in logs, it's quite interesting, because you can just run simple linear regressions, and we would sort of predict the slope of 1. And again, this is our picture. It's basically so we get 1, and all other pictures will get some slope, but it will be different from 1. So this is yeah. So let me. Well, this is just again another way to write it. We try it all different ways. Another way to write this test would be to look at variance per transaction. This is another sort of somewhat typical test that people would do. You calculate that, you basically calculate that how much variance is there per transaction. And again, our theories will give us different predictions about what should be the relation with respect to the order size. So we would say that it should be -2, and other theories would say 1 and 0. So I think, where is it here? So I think that's this regression, that we basically regress how much variance there per transaction is, and we regress it on the log of average trade size. So again, coefficient is sort of -2. Then we sort of looked also at those spikes that you mentioned. For example, the 7:30 spikes and 9 a.m. spikes when different announcements are made. And so you can, for example, this is 7:30 macro announcements. We just filter out, basically, from all of the days, we filter out those days that had those announcements. And you can see that spikes here at 7:30 are much larger than before. Actually, you maybe don't remember those pictures that I showed to you, but they're much larger. And what we want to do with our test, so we want to see whether invariance will actually explain those particular points. So whether these points here at 7:30, whether they are consistent with our results. And this is what we'll get. So this is this crosses would be 3 minutes after the announcement, and the dots here, maybe you don't see them, but there are 3 dots. That's just before 7:30. This is what we get on the left. This is what we get for all days, and this is what we'll get for announcement days. You can see that those crosses move to the right, yeah, because it's when we have announcement, there will be more trading and volume will increase. So that's why these crosses are farther to the right, but still they are on the same two. They're sort of on the same two-foot line. They don't deviate much from it, and it's quite impressive because on the previous picture, this will be really outliers that we couldn't imagine that we'll be sort of matching those outliers, but they seem to be on the same line. We did it also for 9:30. So here we selected 9:30. You can see that there's high spike here at 9:30 in all of these pictures. And again, so those observations are also very close to the same line. These are good results. There are also some other results maybe that are not so good. We try to use invariance, or intraday invariance, to calculate some sort of indicators of some complicated conditions in the market. So this is for flash crash. This is, for example, how the price was sort of dropping here and gone up. So this is exactly the flash crash. And we looked at our measure that has to be invariant, whether it was invariant during those particular episodes. And it seemed that it was invariant throughout the day, actually through the whole flash crash. But it crashed sort of after the official crash was over. So it sort of spiked up here after the market after the circuit breaker was triggered here, and after the market was closed for 5 seconds, it sort of, our invariant spikes up after when the market started to go up already, but not, it's probably, it doesn't seem to be a good indicator of some adverse market conditions before the flash crash. So what else? Well, we did all types of different results. This one, I think, well, let me just show you this one right there. So here, there's a lot of aggregation here. What I was showing to you before, there was a lot of aggregation there because we would aggregate across all days for each particular minute. We also try to do it on disaggregated data. So for each day, we will just look at some means. It could be 1 minute, for example, also. And then we just plotted many observations there. So it's for each day, we had like 1,000 of days there, and each day we would have 1,300 minutes. So that's pretty much how many observations would be there. And again, you can see that it's sort of two-third power or two-third slope again. It doesn't seem to be that there are that many outliers. They're all sort of line up in that nice cloud as before. Let me show you maybe the last result when it doesn't work exactly. It seems that there are some discrepancies from our predictions when we do the following analysis. We take our invariance and then we try to predict what will be the average trade size. So the average trade size, okay, so this is the blue one is the actual trade size. And the green one would be what we would predict by invariance. For each minute, we can look at the volatility, volume, and we can predict what the implied trade size will be. So this is a bit similar to taking when you take Black-Scholes and instead of calculating the option price, you want to see what is the implied measure of volatility. That is difficult to observe. So we do the same here. So you can see that most of the time, of course, because our results were quite good, most of the time the green line follows closely the blue line. But sometimes there are deviations. For example, here there are some, here on the right, this is the actual trade size minus the implied trade size. And you can see that there are some spikes downwards here, for example, or here. So it means that at the beginning of each trading sort of regime, it seems that trade size is lower than it should be according to invariance. And you can see it here, or you can see it here a bit, you can see it here. So it's quite interesting to explain what is actually happening there, why, what is so special about this first maybe 1 hour of trading when each regime starts. It's a bit different at the very end. At the very end, you can see that there's a spike upward. So this spike says that even though there are spikes in both, in blue and green here on the left, but the actual trade size is actually larger than what our theory will predict. A bit. These deviations, if you convert this into contracts, the deviation will be quite small. There will be like 1 to 2 contracts maximum. So we match the data quite well. Those deviations in contract terms will be quite small. But still, there's certainly something happening at the beginning of the trading hours and at the end of the trading hours when US equities market is closing. There's something happening that we don't exactly understand. So I think this is my last slide. In general, I think that these results are sort of better than what we expected originally when we started this project, because we thought that it will not work at all because we thought that Invariance should work for bets, but we sort of didn't think about we didn't think that it will work for transactions because there you need some quite particular mechanisms for order shading algorithms that would make both work, both invariance for meta orders and invariance also for this transaction for the transactions. It's quite interesting to see whether it works in other markets for other securities. Because when we did this research, similar research for U.S. equities, for stocks, then there we didn't look at this particular test, but we look at, for example, the number of trades executed each day for some stocks, and there the results were sort of reasonable, but not as good as here. One hypothesis why we think it works so well here is that that the tick size is sort of very large here, and it just sort of allows us to see those meta orders more clearly than in equities market, where the tick size is more restrictive. Well, less restrictive. There is less of market depth standing on the bids and ask, less of liquidity, and so people sort of shed their orders more than here in E-mini futures. But I don't know. I think that there are quite a lot of still questions that are unanswered, and for me it would be quite interesting also to see whether it works in, for example, Russian markets. So if you're looking for some nice research topic, interesting research topic, I think that applying this sort of ideas for different Russian markets would be quite interesting. For me, at least it would be quite interesting. So maybe I should stop here.
Thank you.
Okay, so questions, please.
Можно задать такой общий вопрос? Видимо, я что-то так в целом не ловил. Вот эти invariances вы нащупали чисто так эмпирически, да, есть какая-то вот за этим, ну это вот эмпирика чистая, да? Вот эти показатели.
Нет, нас изначально, я даже не могу сказать, что был первый эмпирик или теория, потому что это все действительно развивалось как бы.
Здесь все эмпирическое.
Да, здесь это абсолютно просто эмпирически.
Является ли следствием какого-то уравнения?
Ну вот, значит,
сразу.
Нет, вот это нет, это как бы
не является.
Не является. Вот это вот, то, что у нас есть вот это вот наш Invariance для BETS, это как бы, да, у нас есть теория, которая...
То есть это все-таки вот основа какой-то теории?
Да, для мета-ордер, для BETS у нас как бы есть, теория, мы можем объяснить, почему, ну, по крайней мере, наших предположений, почему как бы именно такая величина должна быть константа, но когда мы уходим вот в изначальных заявок, нет заявок, мета-ордерс, транзакция, непонятно, почему это работать будет, потому что каждая мета-заявка может разделяться на много-много маленьких транзакций. Там есть определенный алгоритм, как это делается, и почему те формы, которые с нашей точки зрения должны работать для изначальных заявок, почему они будут работать для транзакций, не совсем понятно. Но это мы работаем над этим тоже, но я могу сказать, что эти теории будут уже намного более сложные, потому что здесь уже будет стоять вопрос о том, как эти заявки прибывают, как они распределены по времени, как они исполняются. То есть это должны быть сложные динамические модели.
Ну да, необъятно. Как вы говорите, это программа. Значит, вы должны сформулировать это
положение, как это все будет действовать, да?
Но я надеюсь, что у нас получится, если мы как бы
Получится однозначно.
Да, мы уже как бы продвинулись далеко в этом направлении, но это все довольно-таки... Те модели, которые будут, скорее всего, это будет довольно сложно, то есть будет динамические модели, steady-state, информация, которая появляется на рынке, трейдеры, которые торгуют с
Сооружение равновесия это нельзя получить.
Ну, вот как это...
Это будет подставиться.
Это будет равновесие, это будет равновесие все модели. То есть это будет те модели, которые у нас есть вот для вот этой формы, когда нет то, что называется одушевление, которое очень сложно моделировать. Там вот тоже модель равновесия, да, можно получить эти формы. То есть это... То есть здесь нельзя сказать, что первый как бы...
А вы все равно вот эту всю информацию обрабатывали, да? Вот эти все средние вычисляли?
Нет, здесь получилось так, что мы как бы с Питом работаем в основном над Invariance. Торбан, Андерсон и Олег Бондаренко, они как раз большие специалисты в области оценок всяких стохастических волатильностей и именно работы с high-frequency данными и конкретно вот с этими данными по имени futures, потому что на самом деле теперь нужно иметь доступ к этим данным. Во-вторых, это на самом деле огромный объем данных.
Ну да, вот это как самому вопрос. Вам приходится вот это все.
То есть мне в этом конкретном случае мне не пришлось ничего делать с данными, потому что Олег и Торбан, они очень большие в этом специалисты, у них уже как бы были все данные, которые они что-то другие исследования делали интересные. Если вам интересны такие вещи, то обязательно посмотрите, вот, чем Торбан и Олег занимаются. То есть у них много разных исследований. То есть, по сути, у них уже во многом были все эти переменные, так или иначе, и просто как бы нужно было на них с правильного угла посмотреть. Что-то такое.
Хорошо, спасибо, товарищи.